Hello, um, this is me doing my accounting lecture, so I understand the accounting lecture I have to do later today. So it's me going through it. And the image is reversed for me on my camera, so I might get a bit confused, but I'm just going to try and not look at it. And yeah, let's just kick this off. So, financial statements, purpose and structure. So the main elements of an income statement are revenues, sales and income, obviously, expenses, costs and expenditures. So it basically just seems to be an income statement. Well, income seems to be what you make from sales. So I'm guessing that's just like the cost of what you make from a sale minus what you spend on the sale. You know, like buying the wood for a spoon or something, or like paying someone a wage to sell the spoon. That's all plays a process in the creation of the spoon and the selling of the spoon. Then the price you get from that spoon would then be an income. I could be wrong, I'm about to find out. Yeah, I got 72 slides to do. I'm on slide 12 because I skipped the first few because that's just a recap, you know. Right, dividends. Right, so income statement format seems to really be anything positive, take away anything negative. That's the vibe I'm getting. So it's like, I'll stop trying to spin. You have revenue. So revenue is just stuff you're getting, right? Let me look this up real quick. Revenue definition. Income when organization. So it's income. Okay. Which means the credit go up, debit go down. Okay. Then you take away the cost of sales, so like the cost of creating the sale, which would be like buying the wood, you know, for a spoon. And distribution costs, that's like paying for the shop. I'm guessing it's for paying the shop, paying to keep the shop that you're selling out of open, and the people who sell it. And then administrative expenses is probably marketing and stuff. Spoon. And you add other income. So that's just any other form of money you're getting in, I'm guessing. And you add finance income, just say it's like money income. I really don't know any other type of income, but apparently there is. Take away the costs of finance. Take away income tax expense. So you know, taxes is going out. That's where you'd cut it for an income statement, I think. And then I don't know what the rest of this is, so we're going to skip it. Purpose of the income statement. Summary of the results of a business's trading activities during a given period. So the purpose of income statement is it shows the profit or loss for the period, but you don't include drawings or dividends. So a drawing is like a withdrawal. Well, my camera is very loosely connected to my laptop. It's in the USB because my laptop only has one USB. So it might die. Yeah, I just cut out. I don't know when this cut out. I think it just cut out when I got into this thing, so I'm just going to start it from the top. And yeah, this is just going to be an awkward slice of like multiple videos when my thing eventually just cuts out again, like when I touch the mouse or something. Okay, so just in built-in music, we'll turn it down a little bit. So the purpose of income statement is it shows the profit or loss for the period. It doesn't show dividends. Now drawings obviously are withdrawal. I'm not 100% sure. Dividend definition. Sum of money paid regularly by a company to its shareholders. So it's just dividend is just the money that you pay to shareholders. Okay, perfect. So it doesn't show any of that. It just shows the company itself spends and excluding like stuff for the people in the company, excluding like wages and stuff. The purpose of an income statement is to enable users such as the owners to evaluate the financial performance. Yeah, so it wants to exclude any of the stuff that doesn't actually show how the company itself is doing. Okay, good. So calculation. So I searched before. I was unsure of here. In the next slide, because I did a quick read through of this prior to looking at it, because I didn't understand it, so that's why I'm doing this. Then between gross and net is, so a gross profit per se would be, or gross income, we'll say gross income. Gross income is your full amount of income, so it's, oh no, we'll go profit because it's in front of me, that's what I'm doing. Gross profit here, it says is sale revenue minus cost of sales. So the cost of sales is basically how much it costs to make the item that you're selling. That's it. So the gross profit is that. Net profit is then you include any other expenses that factored into it, such as wages, such as advertisement, stuff like that. Yeah, so here it says, for example, the company produced 20 pens. Production cost of each pen is £5. 5 times 20, which is £100. It cost £100 to make the pens. During the year, the company sold 10, and they sold them at £10 each, which is £100. But the company only sold 10, so we're only going to factor in the cost of producing those 10 pens, which is 5 times 10, which is 50. And you have £100 profit, 100 minus 50, 50. That would be the gross profit, it's £50. Net profit is including other expenses like selling costs. So some expenses are activity level, like selling costs. So I don't really know what that means. I know what selling cost is. To ask about that. We have a question thing coming up, so let me. What's that? Ooh. Right, I don't know what that is. What's that? Right, no, I don't want to go that. 1 sec. Amazing. So, by the way, I did move room. No, I didn't record a video in here, so this is why. I'm grabbing these just so I can write questions down for my lecture on Friday. So, I want to know what selling costs are. I'll look these up after this as well, because I've got to do another. I've got to watch some Excel thing later as well. I've got a lot of work to get done today, and I put it off until 4 PM because I'm very smart. I had pizza tonight. No, I'll have pasta. I've got some behind me. We'll get down after the yeah, and then others tend to be time based, so like salaries, the staff, and so if you have 20 pens and it takes like 3 hours to sell them, we say minimum wage is £10 or £30 per member who's working at a time. Okay. So sale minus cost of sales equals gross profit, and then the gross profit minus expenses equals the net profit. An example of expenses is rent for the building that you're using to sell said spoons. Spoons, I like spoons. Not in that way. Insurance, insuring the building, spoons, I guess. Rates, don't know what that is. Rates. Repairs, so a leak, you gotta repair that stuff. Wages and salaries, telephone stuff, heating. Okay, it's just depreciation. So if you buy a spoon for say £3 for a very nice spoon, as soon as you've bought that spoon, I'd say it's worth £2.50. Nobody wants. Well, you may as well, if you find it for £3, you may as well just get a fresh one. It's obviously losing value soon as they buy it. Or does it mean that new stuff is coming out? So, say you've invested a lot in this nice normal spoon, and then a week later they invent spoons that salt feed, so you don't even have to pick it up; it just floats and hovers into your mouth. Depreciation on the normal spoon that you made is going to go. Okay. Summary. Structure of the income statement. Okay. So you have two columns. I don't know what the columns are. So profits you put on the right, and liabilities or things that less, more the stuff that gives you more money you put on the right, stuff that gives you less money you put on the left, and then you do the what do you call it? No, I'm wrong. I'm completely wrong now. So you actually gross profit you do on the right hand column, and then net profit you do on the left hand column, but then at the bottom you put the net profit on the right hand column, because if you got a gap here, and you've got a huge gap on this side, you can just stick it in so it sticks out, it's easier to tell. Okay. Get it. Purpose of the statement of financial position. A list of the assets, liabilities and capital of business in the accounting year. Provide information about the resources and debts. Enable users to evaluate its financial position, in particular whether the business is likely to be unable to pay its debts. It's just saying how much money you got. Really what I just got from that. Typical structure of the statement. That's not an income statement, this is the statement of financial position. That's literally saying that we got a bank or we got no bank. Typical structure of the statement of financial position. Yeah, it just seems to be you just do all your assets, all your liabilities, and your net assets is how many assets you got, take away how many liabilities you got, and that equals capital or equity. Oh, what's the difference between capital and equity? Right. Anyway, so the difference between that's me. The difference between a statement of financial position and an income statement is a statement of financial position, an itemized statement of what one owns, what one owes, and what one is worth. Actually, I made notes on this because I went over this last week for my Friday lecture, which I didn't even understand what I was doing, so I'm trying to understand it today. Because Tuesday is my accounting day because I have no lecture there. Let me just find, this should be lecture 4 right here. I would have written all this down. Okay. So, an income statement shows if the business makes profit or loss during a particular period. It's for the year ended. So it's whenever the end of the accounting year is June. We'll just say 31st December. It's so much easier. And it's about your financial performance. So it's how you did over that year. Whereas a statement of financial position is more about the current and now. So it's an itemized statement of what you own and is worth. So it's kind of the stuff you get at the start: assets, liability, and equity. It's basically just about them. to where you're at this very moment, and it's more about what you need to do for the rest of the financial year. So you either make, so if you're in the loss, you need to figure out how to get to profit, or if you're making a profit. Sometimes it's just nice to know, yeah? Okay. The matching concept equals match revenue and expenses. Yeah, you need to match your revenue and expenses. That's the concept. The cost of sales equals value of goods removed from inventory because they have been sold. There you go. It's just the value of things that you sold. So what you paid for them is the value. Let's say the spoon, you paid £3 to buy some wood. Sell a spoon for £5. The cost of sale would be £3 for the cost of wood times however many spoons you sold. So like, say you sold 5 spoons, 3 times 5, 15. The cost of sales is also expense, obviously. It has a debit balance because all elephants. It's one of the, it's part of the debit thing. And your opening inventory plus purchases, and it equals opening inventory, so what you have 10 chunks of wood plus any more wood you bought, so you bought 5 more, minus what you have at the end. So say you have 10 pieces of wood, you buy 10 more, you now have 20, and that you've sold 5, so now you have 15, so then you take away the 15 that you have remaining from that. Boom, cost of sales, and then multiplying that obviously by how much they cost. Okay, instead of doing the 74 slides here, I'm just going to read the notes I made. Hopefully you understand it that way. So, written down value equals net book value equals net carrying amount equals original cost minus accumulated depreciation. I don't really understand what that means. Means my notes are really not that good. Written down value equals the net book value equals the net carrying amount original cost minus accumulated depreciation. So I think it's just different ways of saying the same thing. And what it is the original cost of buying the wood, which is say tenner for a chunk of wood, and that's minus accumulated depreciation, which would be like that chunk of wood losing value over time because either new and exciting things have come out or it's just not that good. So depreciation is the cost of holding non-current assets. So the cost of holding that chunk of wood, you're going to have to pay for things, I'm guessing, this is just me guessing, you have to pay for things like rent to store it, cooling or heat, I don't know, I don't know how you store wood. And that's part of the depreciation of the value of that wood. And once you spend over that, well, then you've lost value on it. Should be charged as an expense. Solid. There's 2 different ways or methods for depreciation. There is a straight line method and a reducing balance method. So the straight line method is the same amount of depreciation every year. So you'd be like, my Kindle loses, I don't have a Kindle over there. My Kindle is worth 10 grand, and every year it loses 5 grand. That's straight line depreciation because every year you'd be in 10 grand, then 95, then 9.5, then 9, then 8.5, etc. Reducing balance method. Oh, so straight line is cost minus the residual value of a useful economic life. So, like, say a Kindle will survive 10 years, then it's worth £10. We'll do that, mate. 10 years, £10. And the residual value, which is the end. I don't know what residual value is. Let's hope that they explain it a bit further down here. Matching concept, okay. So it has some questions and answers. I understand that, but so I do need to go with that as well. I have to watch the video to understand. Non-current assets and depreciation. Okey-dokey. So I meant all this on the page. Two possible ways to value non-current assets. I seem to have missed some stuff in my notes here. Checking it. Historical cost, how much it was worth, I'm guessing. Net book value. Net amount. Historic cost. What? It says, I've put net book value here. There's original cost. Oh, but original / historic cost. Okay. Depreciation, here we go. Yep. I can't understand this bit. Doesn't say what residual value is after all of that. Okay, no, here we go. So the same example. So its original cost is a machine and it's worth 3k. The length of the asset's expected useful economic life, so how much it'll be worth having, 10 years. And the estimated residual value, so the value at the end will be 0. Okay, so we have 10 of one pound of it. Okay, perfect. Reducing amounts method, faster depreciation in earlier periods, i.e. have a rate of 30% depreciation every year, because so you have a house and you bought it for £100,000. Well, houses are really, oh, a car, we'll say a car because they really do go down. A car, you bought it for 10k, 10 bags. It loses 30% every year. So in the first year, losing 30% of 10k, which is 30k, 3k. Now you're down to 7 grand. Then you lose in the second year, you can lose 30% of 7 grand, which is 2.1k. So you'd be up down to 4.9. So the value is getting lower each time, but it's like a set, so like 30%, 30%, 30% type of thing. Profit on sale if proceeds are greater than the net book value, and then you lost if the proceeds are less than net book value. Yeah, okay, that makes sense. So if you make a profit, if it's worth more than how much? Oh no, I can't understand it. Kind of, a little bit. 3 main steps for estimate for entries of disposals of non-current assets. Okay, entries for disposals of non-current assets. So disposal, I don't know what that is, but I'm just gonna guess. It's something like what's it like? A disposal of non-current assets. That's like getting rid of it. I'm gonna guess it means what disposal means. Just get rid of it. What time am I at? It's 4:46. Okay. You record the value of how much you sold it for. And then you reverse all entries in the books in relation to the asset. So say you spent 3k creating something, you reverse that, so now you're making 30k. I don't know. Close the asset disposal account, partial year depreciation. Right. Partial year depreciation is when a non-current asset bought or sold partway through an accounting year. Depreciation expense is computed either. So when something that's depreciating, and you sell it halfway through, so you sell it in like July or something. Depreciation expense on the asset is either on a strict time, it says the year that you got it, and you just deduct that from it. So say you bought it start 2021, you sell it in June, you're going to accept that depreciation is just however long you've had it for. Or on a strict time basis, it's in the year of acquisition and in the year of disposal. So you buy in 2020, sell in 2021, that's 6 months. Guessing they're going to include a year there. Oh no, I am really confused with this. I'm going to have to look over this. If the above date is not given, so you don't know when you bought it or when you sold it, 4 years charge in the year of purchase, none in the year of sale. Great. Well, I understand the basics. It's just the logistical side of it that I'm a bit confused with. So, yeah, I'm going to have to watch a video on that. But this was helpful for me anyway. So, I bid you adieu.